Hi fools, and welcome to another video from the Motley Fool. I'm Owen Benelek, and today I'm going to talk about Lloyds Shares. Now, if you were here a year ago, fools, we would have been talking about how the government will never get rid of its Lloyds Shares. I didn't actually believe that, but that was the headline of the day. Lloyds Shares were, 30p, 35p. George Osborne was going to have to sell them at a loss. Woe to taxpayers everywhere. What a difference a year makes. Now Lloyds Shares are hovering around about the government's break-even point. This is about 62, 63p, depends how you do the sums. And, everything's changed. Now the government's headache is how's it going to get rid of these Lloyds shares. We, the taxpayers, own about £17 billion worth of Lloyds shares, and the government doesn't really want to hold them forever. It wants to get it off the balance sheet, book some profits. So what's changed? What's changed in a year? Well, there are things that have fundamentally changed. Europe, for instance, while still an absolute disaster of an economy, doesn't look like it's going to blow up. People have just got more generally non-averse, risk-confident. But Lloyds itself has also carried on with this program of disposing of the dodgy stuff that we should never have bought, which it calls non-core in retrospect, and keeping the core stuff, the stuff which we think of when we think of a bank like Lloyds. So only last month it sold quite a lot, I think £2.7 billion worth of residential mortgage-backed securities. These are literally the toxic stuff that was at the heart of the financial crisis. Not so toxic now, which is the irony of time. Again, let some time pass, things tend to change in investment terms. It's also offloaded a lot of its St James's Place shares. It's sold an international financial business it has that made losses. All of this is slowly bringing up its core capital levels. Basically, the amount of money that, if a lot of things go wrong, it's still got at the heart of the business. That, this is what regulators now are absolutely obsessed with. And on that note, the new PRA, the Prudential Regulation Authority, this is the sequel to the FSA, now has told investors that it doesn't think Lloyds is going to have to raise any money. That's amazing. If Lloyds had to go out and raise another £2-5 billion when the shares were about 35 pence, can you imagine what it would have done to the share price? Now the shares are 62p and looks like they're not even going to be diluted. So I think the only real risk, I won't say only, it could be an asteroid or there could be, just a general disaster in Europe again. The big risk, let's say the big risk, is Lloyds is very geared to the UK housing market, the UK economy. But I still think the biggest risk really at the moment is that the government sells the Lloyds shares for profit, gets it off their hands, and then starts hitting Lloyds because it's so dominant and it's so profitable. Probably 2 or 3, 4 years away, but I think that's the big risk, and I'm happy to take that risk.